Hi guys, Donnie Schultz, Embrace Home Loans here with your weekly rate update, Thursday, March 31st, a little bit after 6 p.m. Getting this out a day early just because I'm going to be on the road tomorrow, but I did want to give you some insights on what markets are doing because we have seen a little bit of a pullback here. Big question right now, and it's been the question since rates started going up. Mid-December, early January, we really started seeing rates accelerating and markets shift to absorb the repositioning for this inflation fight that we're in right now. Is where's the top going to be? Last week we saw rates go up 0.5%. So if you watched last week's video, all indicators were that the move and the speed really pointed towards a topping out of rates that are higher than where we are today. Best guess, highest odds would probably be between 5.5% and 6% on a 30-year fixed rate for markets to get to a point where we would expect them to start pulling back. Now, that move last week did put us in a position where we were expecting maybe a little bit of a pullback. 10-year Treasury got up to some very key resistance levels. You can see it on my chart here with all these lines. 2.5, big target on the 10-year Treasury, big pivot point. You would expect from technical trading for buyers to step in there and drive rates a little bit lower. That could absolutely become a top of the market, but we probably need a little bit more of a reason behind it. So, we hit 2.5. It coincided earlier this week with some headlines from Russia, Ukraine about a potential ceasefire. That drove down oil prices, which lowered inflation future expectations. That's good for rates. If a ceasefire does occur in Ukraine, this could turn into a top. We might have seen the highest interest rates right here in March 2022, and rates will steady down and possibly go a little bit lower. I don't think that's the most likely scenario. I think even with a ceasefire, I think the most likely scenario is that these rates are going to continue to move higher as the Federal Reserve increases their shorter-term interest rates. 10-year Treasuries have narrowed down. You might have seen some headlines about the 2-year, 10-year inversion earlier this week. Right now, they look like they're trying to invert again. To step back and just explain how this all works, the Federal Reserve is increasing their rates. They're reducing the amount of money that they're putting into the markets to slow things down. They're pulling money out of the market. They're making things more expensive. They're doing this to fight inflation. It takes time. Federal Reserve has only increased the federal fund rates by 0.25%, one increase. The next 6 months, markets are expecting them to increase another 175 basis points. There's going to be 50 basis point increases at the next couple of meetings at least. They might surprise with a 75 bip increase. Those increases will slow things down, but it hasn't hit the numbers yet. It takes time. So I think longer term rates are still going to be under pressure. Not as much pressure as shorter term rates, but they will still be under pressure moving forward. I think that target of 5.5%, 6% is still the most likely scenario, but we do want to try to identify these moments where buyers can capitalize on technical trades. So last week, rates moved up so high, so quickly. 10-year was coming up to that 2.5%. We took a lot of buyers into this week who were going into contract, and we said, hey, there might be an opportunity to get these rates a little bit lower. And that's what we saw. We saw a 0.375% dip through today. Today, clear signs that risk is increasing. They ended, stocks down at the end of the day. Mortgage-backed security prices down at the end of the day. Tomorrow, non-farm payrolls report always creates a little bit of volatility. I don't know how much weight markets will put into that report, but we are going to start getting into the economic data that is going to dictate the Federal Reserve's policy in 2023 and beyond, and that's going to have a big impact on what rates do for the rest of this year. Right now, 2022 is baked in. Everybody knows what the Federal Reserve is going to do. They're going to be super aggressive. That's why we've seen these big spikes in interest rates. I would expect it to settle down a little bit here, but the trend should continue to increase. And then we're going to have to keep a really close eye on data. What is inflation data doing? What is payroll data doing? What is unemployment doing? There are economic reports that are released weekly, daily. Next week, pretty light week on economic reports, but we want to keep an eye on this, and we want to try to identify those opportunities for our buyers to capitalize on dips in rates. We want to keep our buyers protected. Right now is still, outside of maybe a few day window, it is still a time where buyers should be locking in. They should be protecting their rates. High risk not to be right now. And for future buyers, we want to identify, hey, where's that potential top? When are things going to potentially reverse here? So we're keeping an eye on it. We're trying to keep you updated every week. Hope you guys are joining us. Hope you're getting value out of it. If there's anything else you'd like to see, shoot us a message. Can include, definitely once whenever there's updates to programs, guidelines, we're definitely going to include that in here. It's been pretty quiet the last 3-4 months. Not too many releases from Fannie Mae, Freddie Mac, FHA, jumbo side, but we'll bring that to you when it does. Hope everybody enjoys their day. I'll see you guys next week.